You were talking a little about duration earlier, but how much duration are you willing to take on given some of those large fiscal concerns, the tightening by the Fed? How much control is there really over the long end of the curve? And how much danger is there when you look past the 10-year?
Yeah, Monty, I think the intermediate part is the sweet spot, especially on the taxable side. If you look at the credit markets, the double B, triple B areas that we like to play with a duration of around 4 and 5, those are still a 6% type handle yield. The conversation is a little bit different on the muni side because of the demographics, because of the supply-demand imbalances, and because the muted nature of municipal volatility generally. So we're a little more constructive on duration there. But to your point, the MOVE index, the measure of treasury volatility, unlike the VIX, the measure of equity volatility, is still extremely elevated. So the highway of interest rate outcomes for the 10-year is still very wide. So caution on duration, particularly on the taxable side, is warranted here.
How much caution do you have when it comes to steepeners as well? You have had investor after investor pitching buying curve steepeners going into the end of the year, except for if you look from the beginning of November to now, we've actually inverted quite a bit on the 210 curve.
Yeah, and we continue to invert with that clock ticking between inversion and recession, which we know is one of our tells that has failed us at least up till now at this point. I don't think the 10-year eclipses 5%. I think the 4.99 will be the high watermark this cycle. I think the range is going to be that 3.75 to mid fours for the next couple of quarters, and I'm comfortable owning treasuries in anywhere in that range for the next 5 to 10 years.
James, the other thing that you point out is that credit bonds in the triple B and double B sectors still offer 6% yields. Are you happy with those? Are you looking for opportunities in that arena?
Yeah, I think the case for the double B sector has never been stronger. Since 2009, defaults have almost been non-existent in that space. And what we've learned through this period of very, very low interest rates is corporate America has gotten very comfortable functioning in those double B, triple B areas. We've had a number of upgrades in the double B space. We have what we call rising angels accreting up into the triple B space. And when you can sort of, to us, that's the sweet spot of yield in credit. Those two sectors, which encapsulate roughly half the IG market, roughly half the high yield market. You don't have to go way down the stack. And if you look at a 6% yield, Sonali, and you look at that relative to equity risk premium, and you look at that relative to most folks' investment policy or investment objectives, that's hitting a lot of marks. And we think that that's going to be, especially for balanced investors, a very good entry point in that particular area, along with some of the agency and agency-backed mortgage securities, which spreads have gotten very wide because of the vol in the Treasury market. There's some yield out there to be had, and let's not put it under the mattress. Let's not get too comfortable with these money market rates, which have been nice and been attractive, but they're going to be fleeting if the Fed and the markets are going to be true to what they're telling us up to now.